Now let us see the next concept, that is cost of capital. What is cost of capital? Cost of capital of a firm is the minimum rate of return expected by its investors, and it is the weighted average cost of various sources of finance used by a firm. That is, we know that every firm incurs cost. For example, even if we also get loan from a bank, what is that we are paying? We are paying interest. So here we have to understand the concept why cost of capital is important and why the firm wants a minimum rate of return that is expected by its investors. That is, it is the weighted average cost of various sources of finance used by a firm. So what are the various sources of finance used by a firm? It can be shares, equity shares, preference shares, and debt capital. So the capital used by a firm may be in the form of debt, it may be in preference, and it may be a retained earnings and equity shares. So the concept of cost of capital is very important because a decision to invest in a particular project depends upon the cost of capital, because we have to calculate and we have to make calculations for the cutoff rate, which is the minimum rate of return expected by the investors. Because when we are investing in a bigger project, we have to calculate what are its return on investment aspects, and within how many years we will be getting back the investment, and what will be the rate of return that is generated from the project. So based on these aspects, we have to calculate the cost of capital aspect of a firm. And let us see the definition of it. A cutoff rate for the allocation of capital to investments of projects, and it is the rate of return on a project that will leave unchanged at the market price of the stock. So here, since the investor are also on the upfront point of view that what we are investing and how much we are investing and how much we are getting at the end, and we have to see that the price of the stock should be unchanged. It should be increased. And the another definition is cost of capital is the minimum required rate of earning or the cutoff rate of capital expenditures. And let us see what is it. Next concept. And these are the cost of debts and cost of measurement of cost of capital aspects. Now let us see the dividend. What is the meaning of dividend? Dividend refers to the business concerns net profits distributed among the shareholders. It may also be termed as a part of the profit of a business concern, which is distributed among its shareholders. And according to the Institute of Chartered Accountant of India, dividend is defined as a distribution to shareholders out of profits or reserves available for this purpose. So generally, this dividend refers to the business concerns, not profits, net profits distributed among the shareholders. At the end of the year, if the company is in profit, the profits are to be distributed to its shareholders. And this distribution to shareholders out of profits or reserves available for this purpose mean that it should be seen that the shareholders are given an interest and shown that they are to be paid dividend every year from the profits, so that investors will be having a confidence about the company's operations, and more investors will be coming upfront in order to invest in the company. so that the value of the firm also will increase and its market price also will increase. And now let us see the factors determining dividend policy. What are the factors determining dividend policy are? First one is profitable position of the firm. So if the firm is in profit only, then only it will be having the scope to distribute its profits. Then only profits can be distributed in the form of dividends. So if the firm is in profit position only, it can distribute profits. And uncertainty of future income, because we doesn't know what happens tomorrow. Since it is uncertain and we cannot decide what can be the dividend policy tomorrow. Since future income is very important factor which affects the dividend policy, and shareholders need regular income, the firm should maintain a regular dividend policy. Then only the firm can survive and investors also will have hope, and it will be a positive sign to the company also. And next one is contractual constraints. Often the firm's ability to pay cash dividends is constrained by restrictive provisions in a loan agreement. Generally, these constraints prohibit the payment of cash dividends until a certain level of earnings have been achieved. That is, every company is having a constraint in order to pay what level of dividend, and a certain percentage of earnings are to be kept with the firm and certain percentage of earnings are to be distributed to the company, distributed to the shareholders. And next one is internal constraints. That is, the firm's ability to pay cash dividends is generally constrained by the amount of excess cash available rather than the level of retained earnings against which to charge them. That is, it is everyone will be thinking, since it is a borrowed fund, what is that we have to pay? As a lender, in generally, we will be thinking about, since it is a loan, we have to pay interest to it. Because a certain amount of interest rate is to be paid to the debt holders. So here also, as an internal constraint, we have to look into those aspects where how come we have to frame a dividend policy according to the earnings that the company is going to get. And the next one is growth prospects. So in keeping view of the growth prospects, that is how come the company can expand. In order to expand, it should have a very good dividend policy. That is, the firm's financial requirements are directly related to the anticipated degree of asset expansion. So in that process, it may need all its funds to finance capital expenditures, or else the firm exhibiting a little or no growth may never need replace or renew new assets. And a growth firm is likely to have to depend heavily on internal financing through retained earnings. Since it is having a growth aspect, it has to distribute current income as dividends so that the investors can have hope on the company and it can go further. And the next one is owner considerations. So in establishing a dividend policy, the firm's primary concern normally would be to maximize shareholders' wealth. On such consideration, the tax structure of the firm owners are supposed to have a large percentage of wealthy shareholders who are in a high tax bracket. So in that, we have to look into the payout of a lower percentage of its earnings to allow the owner to delay the payment of taxes until they sell the stock. So, and the next one is market considerations. So the risk return concept applies to the firm's dividend policy. And what is that risk return concept applies to the dividend policy is, it is a part of risk return concept. Dividend policy is also one of the part of risk return concept. That is how much amount of risk we are in if we distribute the profits in the form of dividends. So here, a firm where the dividends fluctuate from period to period will be viewed as risky, and investors will require a high rate of return, which will increase the firm's cost of capital. So the firm's dividend policy also depends on the market's probable response to certain types of policies. And the next one is legal constraints. And according to the Companies Act 1956, we has been put several restrictions regarding payments and the declaration of dividends. And similarly, Income Tax Act also lays down certain restrictions on payment of dividends. And next one is liquidity position. And liquidity position of the firm leads to easy payments of dividend. And if the firms have high liquidity, the firms can provide cash dividend. Otherwise, they have to pay stock dividend. And the next one is the sources of finance to issue dividend. And if the firm has finance sources, it will be easy to mobilize large finance, and the firm shall not go for retained earnings in order to distribute dividends. And the growth rate of firm, and high growth rate implies that the firm can distribute more dividends to its shareholders. As we already know that if there is a growth prospect to the company, there is no way to think about whether to distribute dividends or not. And the tax policy that is framed by the government also affects the dividend policy of the firm, thinking about that by issuing a dividend to the shareholders gives them tax incentives. And that's why sometimes companies pay more dividends. And the last one is the capital market conditions. See, as we all know that everyone is keen about the information about the market and looking what companies are doing, and hence these aspects play an important role on the market. And this, due to the capital market conditions, dividend policy may be affected. And if the capital market is perfect, it leads to improve the higher dividend.